5 things. The biggest investing mistakes. Joining us is Ed Butowsky, managing partner of Chapwood Capital, with numero uno. Hit me.
I would say that the number one problem people have in investing is they target too low returns. And because of that, they don't pay attention to inflation. And your inflation, my inflation are different numbers than a lot of people who are listening today. But the targeted number right now is about, let's just say 5%. You have people investing at 3% CDs or 4% fixed income. You take taxes out after inflation, and you've lost purchasing power.
I know, but they're thinking, I just don't want to lose principal. I just want to park it into cash. Cash right now isn't really anywhere. It's hard to find a place to put it in cash where you're going to be.
That's absolutely right. We're basically living in a financial paralysis because you have a poor stock market, you have low interest rates, and you have very high inflation. So that's the number one problem. What do people have to do to solve that? They have to become better educated and not shorten their time horizon.
Number 2. You're going to get my hallelujahs and amens because this is the biggest thing that people mess up on.
Number 2 is real simply fees. And I used to work at a very large investment firm, and I had a front row seat to see what people are recommending. And I will tell you that people pay easily over 1% more than they should in their fees. And you take a portfolio, let's just take a number of $500,000. 1% savings is $5,000 a year. And if you took that money and invested it and grew it at about 8%, roughly some number like that, you'd have an extra $72,000 10 years from now. You can do a lot more with your life if you have a little bit more money and you reduce those fees. There's a website you should go to, or everybody out there should go to, is finra.org. And in there you can analyze and look at what mutual funds and separate account money managers that are recommended by investment firms, what they charge versus the corresponding exchange-traded fund.
So if a client came to you and said, hey, Ed, I want you to cut your fees, you wouldn't mind?
We start off so low, we couldn't cut them too much lower.
All right, thank you. Second, third. What's number 3?
The third one that we talk about is correlations. And this, everybody should Google the word correlations and understand exactly how investments move up and down together. Right. Too often people think they have a number of investments, and that means that they are well diversified. You have to look deeper and understand how they go up and down together. And a lot of portfolios that we bring in to do forensics on, we see that they all go up and down together. That's a huge problem.
Number 4 is a little more complicated, though, for people.
Number 4, there was a gentleman named William Sharpe who won a Nobel Prize in economics. And even though that sounds very sophisticated, everyone, again, I'll use the word Google again, but Google the Sharpe ratio. This is a way to compare apples to apples, and people aren't doing it in
your risk-adjusted return.
Right. People are taking too much risk for the return that they're getting on their portfolios, and that is a problem. Challenge your broker, challenge your financial advisor to teach you and show you what your Sharpe ratio is.
The higher the Sharpe ratio, the better the risk-adjusted return, and it really works if you're comparing similar mutual funds, for example, to see which one produces the most return.
Right, just like a credit score. You want a comparison? You want a side-by-side comparison? Look at your Sharpe ratio. That'll tell you.
Last one.
The last one is the cocktail party stock syndrome. This is, and today there aren't a lot of tips that are going around, but just suggestions on what you should buy. What happens in a cocktail party? Someone gives you an idea, you follow the idea, and what happens? It doesn't work out. Then you run away from the stock market, and you never get back into it, and therefore you don't keep pace with inflation.
But that is breaking psychology, though, Ed, because people still, many, view stocks as a get-rich-quick scheme, and it's really not that.
No, the only way you will keep from losing to inflation is by owning things that can go up in terms of stocks and some sort of equities. And the biggest problem we have today is education. You must demand more from your financial advisor, and you must go out and start learning a little bit more to keep pace.
Thanks so much, Ed.
Thanks for
having me. Welcome back anytime. Ed Butowsky, managing partner of Chapwood Capital.
Take
care. Be well.